Good morning. Welcome back to another Money Not Math conversation. I love our country, but I believe our government is terrible at managing money and should not control your financial future. So I do these conversations in hopes that I can bring you value. Today, we're talking about the risks or value of trying to time the market. Do you believe in trying to time the market? Do you believe in trying to pick stocks when they're going up or sell when they're going down? Do you think that your ability to Google and do research and time the market is better than the experts? All right, welcome back to the conversation. It is Thursday, December 1st. Welcome to December, everyone. And welcome to the holiday season where the next 4 weeks are probably going to go by faster than 4 days normally feel. Today's conversation, as I started out saying, is about the risk of trying to time the market. And to have this conversation, I'm going to be utilizing an article written by Dimensional titled Time the Market Your Own Peril, written by Executive Chairman and Founder David Booth. And it starts out by saying, technology enables immediate access to everything wherever and whenever we want it. In many cases, such as staying in touch with friends and family or learning about world events, that's a good thing. However, when it comes to investing and money management, my fear, or their fear, David's fear, is that faster and easier ways of investing will allow people to lose money faster and easier, and more of it for that matter. And we're seeing that right now with the FTX crypto stuff, the billions upon billions of dollars that's being lost by people who are trying to get rich quick by investing in this crypto exchange, that are now being completely, their money is just not available. It's gone because of, I don't know if it's fraud. We'll wait to see what ends up happening, but it's amazing how trying to be first or trying to get rich quick can really bite people in the butt sometimes. So like he said, with technology that we have available to us today, his fear is that it's making it easier for people to lose money, more money, faster and easier. As access to investing expands, it becomes even more important to adopt an investment plan that doesn't try to actively pick stocks or time the market. The purpose of having an investment plan is so you can relax. So you don't look at the market every day, stressing out and asking, how am I doing? How am I doing? Investors actively trading are not just potentially missing out on the expected return of the market. They're stressed out, worrying about how the news alert they just received will impact their long-term financial health and whether they can or should do anything about it. And this point is so important. So we often talk to people that think they don't need a money manager or financial advisor or financial planner in their corner because they can do it themselves. And you might be right. However, there's two things I want to bring to your attention that I believe. First, I can Google almost any job in the world. It doesn't mean I can just show up and do the job. How and why will we do something is far more important than what we actually do. The second point to that is, even if you do have the capability to do all the research and all the financial planning and all the investments on your own, do you really want that stress added to your life? I'm sure you have a full-time job or a full-time business or something that you'd rather be doing with your time than something that someone like myself does all day, every day, and can provide that resource to you for probably 1/10 the amount of time it would take you to do it all yourself, if not less. So it's really important to understand not only what can you do, but what should you be doing, and then prioritizing it in an important way that reflects your long-term goals. So coming back to the article, he doesn't blame people for this. The financial services industry has not done a good enough job educating investors that the best approach for their long-term financial well-being is to make a plan, implement it, and stick with it. His fear, again, is that faster and easier ways of investing will allow people to lose more money faster and easier. But it has done a great job of selling index funds. Over the past decade, the percentage of the stock market that is passively held has grown considerably, with equity index funds representing most of, I'm not going to go into all the numbers here, but basically because of the understanding that not trying to time the market is actually more effective than trying to time it, index funds have become very popular over the last 30 years, especially the last decade. And it's now become a majority of all investing is into indexes throughout the entire stock market. So despite the overwhelming evidence and compelling story to the contrary, when economist Michael Jensen published his landmark 1968 paper, which showed that active stock pickers added no consistent value, other academics soon confirmed his insights. More than 5 decades and 50 years of data later, the theory still holds up. There are some stock pickers who experience success, but we don't know how to identify them before the fact. We can't separate skill from luck. Picking stocks is more like gambling than investing. So I've read this many times in the past, but I believe the statistics say that if you take any 10-year rolling period, I think it's 97% of investors that try to time the market actually lose to the market. So you'd be better off just buying and holding an index than 97% of people who try to time the market. The academic research inspired the invention, which is why it's so important that the plan itself is where the time is spent, not trying to pick stocks when it comes to building a financial plan. This academic research inspired the invention of the index fund, which allowed investors not only to buy the broad stock market, but also to track the performance of the manager and compare costs. He worked on one of the first index funds when he co-founded Dimensional. They built strategies that were informed by indices, but weren't limited by the same mechanical constraints. So they accepted this research early on and built a company based on it. He still believes that 50 years later, his colleagues and him weren't sure at the beginning that it would appeal to a lot of people, but it did. And this is why I utilize dimensional funds for a lot of my clients, is because I believe in their approach of utilize, from a very base and foundational standpoint, belief in indexes and not trying to time the market, but then even more in depth, refining those indexes with research and understanding that the buy and hold strategy is the best strategy, but it doesn't mean we have to completely disregard research when it comes to value and price and things like, and dividends and things like that. So he's proud of the fact that we have always viewed marketing as a way to educate financial professionals and investors. In fact, they started by working with institutions and only expand to individual investors by working with financial advisors like myself, who could help teach our clients how to think about the market and invest for the long term. He wanted to prevent people from making the mistake he still sees way too many people making, and that's trying to time the market or try to pick stocks that are going to beat the market. But his fear, it will only get worse. ETFs or exchange traded funds make it easier to trade. So do free platforms that allow people to trade on their iPhones or any other phone like Robinhood. There seem to be as many ETFs as there are stocks that make up those ETFs. He really likes ETFs. They are another chapter in the 50-year story of creating safer and better financial products for investors. His firm has been using them to give financial professionals like myself and investors more choice in how they access dimensional investing, but they are tools and they have to be used effectively. And I think that's the most important thing. That he makes in this point he makes in this paragraph is that it doesn't matter if we're talking about 401ks, ETFs, mutual funds, indexes, life insurance, whatever it is. Those are just tools that we have to utilize within a plan, right? If you imagine you got your toolbox, you got your hammer, your screwdriver, your measuring tape, and everything else. It doesn't matter if you have the best hammer in the world. If you don't have a nail that needs being hit, the hammer is not the right pick. Okay. If you have a screw, you should use a screwdriver. So it's extremely important in the financial advising world that we understand what tool we need to accomplish the goal at hand, not just what's the nicest, best tool out there. I see that so often where people are always being sold the hottest stock to buy or the hottest index to buy or the hot new investment to buy. And next thing you know, they've got 10 tools in their toolbox that are the exact same, but they've got a bunch of blind spots because they haven't built an actual financial plan. They've been just sold a bunch of financial products. Hopefully that the difference there is clear. So continuing on, which is why you may need an advisor more than ever, as states David Booth here. He's stating that the advisors to help you understand the difference between financial products and financial plans and how the products fit and the tools fit within plans. So to help you from jumping from one thing to the other. His approach is to get you out of the game of worrying and guessing by having a plan that can provide peace of mind. It's a sensible approach you can live with. Trust the financial advisor who trusts the market. The financial industry has made great strides improving the investment options available, but we have more work to do helping investors with those options. There are great solutions right in front of people. As an industry, we need to do a better job of educating current and potential clients. How the bulk of our society lives out their later years depends on it. And this is, again, a really important point. So we see this especially with our government, but especially the financial industry as well. Whenever they see an issue, they sell a new product to fix the issue, but they don't actually educate people on the issue and the underlying cause of the issue. And the example of this recently is that because we have such a massive deficit or issue in our country when it comes to retirement planning and the amount of people who have to decrease their lifestyle in retirement. Well, the government's like, okay, let's fix that issue by allowing people to invest in annuities through their 401k. Well, that doesn't really fix the issue, because if people aren't saving enough in the first place, and they don't understand how annuities work, and they don't understand how their 401ks work, by allowing another tool within the 401k to be available, that you're not really solving anything. You're just making it look like you are by selling another product. Okay. So again, super important point. I know I made a lot of them during this conversation, but I hope at least one thing stuck out to you. At the end of the day, timing the market is a risk. It's, if you want to try it, go for it, but that's not what I do. That's not what I do for my clients. And I tell people who ask me to do it for them, no, good luck trying to do it on your own. I don't believe in it as a strategy. But please let me know what your thoughts are by commenting on this post and or reaching out to me directly. Let me know any questions you have, any thoughts you have on this conversation specifically, or requests you have for future conversations. And as always, I genuinely appreciate those of you who take the time to share my posts and like or comment on them as well. Again, this is Drew Erickson. It's Thursday, December 1st. Hope you have a great day, and I appreciate your time. Thanks. Bye.